Hello and welcome to the New Age of Risk Analytics podcast. Today we speak on credit risk modeling and decisioning with Ivy Tan, EY Senior Manager specializing in IFRS 9 and credit risk for the financial services sector, and Vikas Sharma, an Associate Partner at EY also.
I'd like to welcome you both to the New Age of Risk Analytics podcast. I'd like to just ask you both for some background on your current roles and responsibilities and how it relates to our topic today. Let's start with Ivy Tan, EY Senior Manager, specializing in IFRS 9 and credit risk for the financial services sector. Can you tell us a little bit about your current role and responsibilities?
Sure. Thanks, Melissa, for inviting me to this podcast. I am a credit risk specialist based in Ernst & Young Singapore office. My role is primarily to assist the EY assurance team in credit risk-related audit and advisory work for the banking clients, hence my title, which sounds quite a mouthful.
Thank you. And now Vikas, an associate partner at EY, who we are pleased to note is a certified FRM. Vikas, can you tell us about your current roles and responsibilities?
Thank you, Lisa, for your time and welcoming me here. I lead risk data analytics and reporting solutions for financial risk advisory practice in EY Singapore. Now, through the years, I have advised financial institutions on credit risk, primarily covering credit risk modeling and credit risk process. I also cover other financial risk topics such as market risk, liquidity risk, and operational risk. More recently, though, in line with how our client needs are evolving, my focus has moved to data governance, regulatory reporting, and now, more recently, use of AI and machine learning in risk and compliance.
Well, I'm sure that's a fascinating trajectory. And, we certainly have, GARP has obviously a broad base in both the financial and energy sector of risk practitioners who work in various arenas, both market risk and operational risk and enterprise. From your perspective and your expertise, I'll start with Vikas. Can you give us an overview of credit risk modeling and its understanding of the risk profile of a firm?
Credit risk modeling is, in simple terms, translating the demographic and financial data of a customer to a creditworthiness metric. This aids in credit decisioning and portfolio management, leading to the desired risk profile of a firm's portfolio. The metric can be used by relationship managers to propose the right transactions, by credit officers in assessing creditworthiness of the borrowers and then making approval choices, and then by portfolio managers in recommending the right mix of sectors, geographies, customers, and products.
That's very interesting. Ivy, do you have anything to add to that?
Well, for my banking clients, credit risk modeling to them is just an analytical tool that they use, basically just to organize data in a statistically meaningful way so that it helps them in making better credit decisions.
Absolutely. Because you mentioned, machine learning and AI, and we are hearing from so many risk practitioners that the landscape is changing substantially at the moment as a result of technology, also regulation and other issues. But let's start with technology. Are you finding that your role and responsibilities are really shifting because of this new technology?
Yes, certainly. I think changes in the technology are bringing innovation to every aspect of credit origination and management. Today, in today's world, technology is creating new channels for us to reach the customers, enriching the data sets, while from process point of view, a number of our clients are now focusing on automating and digitizing their legacy credit process. Today, we have access to alternative data sources if you want to build scorecards for the unbanked population. At the same time, we're also pursuing more updated credit modeling techniques, although I have to admit that there are problems with explaining the outcomes and relating those outcomes to the inputs. But I also firmly believe that this is just the beginning of the change.
I think that's certainly the case. Ivy, do you want to talk a little bit about some of the regulation changes that are occurring? Has your job shifted in the past few years because of things like IFRS 9 and CECL compliance?
Yes, certainly. IFRS 9 has been impacting the financial institution quite a fair bit. From what I'm seeing, the biggest challenge of IFRS 9 is it requires cross-functional teams to work together because it's no longer a silo function where credit does their own thing, finance does their own thing, operation does their own thing. IFRS 9 actually calls for the integration and the cooperation of these various teams. You need your finance guys to work with your credit guys, to work with your ops guys. So that, in fact, is a bit of a challenge that a lot of my banking clients are trying to work through and trying to get all this team to align over a long period of time. So we can certainly see that regulatory and accounting changes sometimes does affect how a organization think about new ways of doing things.
Yeah, and I actually have a question along those lines. I think the nature and profile of teams are changing, and there's sort of skill sets are changing. What are you finding about as these regulations are implemented? What are you finding are the biggest challenges in getting teams to communicate and sort of break down those silos?
Well, from
and do you have any advice along those lines from your wisdom?
Okay, not so sure about advice, but more of like from what I'm seeing from the big MNCs banking clients that I have, a lot of time to encourage communication across team. They have to promote agility, and they have to promote what they call cross-functional teams. So the way a team is set up traditionally, where basically you have, let's say, finance person reporting into a finance person, probably doesn't quite work in this new era where you need communication and cooperation across different functions. So what I'm saying now is more of like setting up teams in line of projects or like for a particular task, like for reporting. And then you pull different people from IT, from the risk guys, from finance, and everybody just get together in a team where everybody is a specialist, but yet at the same time working towards a common goal and reporting to maybe a senior manager who is like overseeing the entire project. So the traditional way of looking at function, looking at team is actually changing in this age. And also with digitalization, a lot of automation tools is being used. So it helps in working in this kind of cross-functional team where everyone works on different things, but basically trying to achieve the same objective.
Are you finding that as well? Are you seeing those changes as well, Vikas?
So I think when we talk about IFRS 9 or any big transformational regulatory changes, to operationalizing these kind of processes, you need to maintain a minimum bench strength. And I think the teams that you have trained for such processes or running such processes, the same teams could then be also leveraged to run other credit models or other reporting processes. Now, I could give an example. If you have invested in the infrastructure and you have this infrastructure ready to provide the right data in the right form, the same data then can be used for internal risk reporting, and the teams that have been working on IFRS 9 could also be then leveraged to report internally to risk committees.
That makes terrific sense. I'd like to talk a little bit more about data integrity and integration of systems. We've talked about how the teams, and I do think that there's some adaptation, but, in automating these processes, you really have to worry about the data integrity. What are you finding are the biggest areas of focus when you're addressing those kinds of issues and ramping up with these new technologies and complying with these new implementations of regulation?
Now, data integrity is certainly critical to ensuring that you have the right data in the right form, and accuracy and the completeness of the data cannot be ensured if you do not choose the right data sources with adequate controls. Certainly when you automate and you centralize the process, you have to think about the data governance around those processes to ensure that you have these controls in place, and then the data that you are using for any measurement methods or reporting has met the standards that you have that you have set for yourself. So essentially, that's the biggest concern that I would say that industry would have.
Do you agree with that from your perspective, Ivy?
Yes, I agree that data integrity is critical, in fact, for my banking clients being the regulated entities that they are. A lot of times they place a lot of emphasis on governance because they need to be able to trust the results that's generated from all these models that they use. And most importantly, for the financial institution, they need to use these results to do financial reporting, to do regulatory reporting. So they need to be sure that the result they are using is something that they can trust and they believe in.
Do you have anything in particular that you think is really critical for our listeners to know about data integrity in this work and how you approach governance with regard to that element? You know, are you finding that there are certain techniques in looking at governance that are particularly helpful, or are there areas which you feel like people need to really keep a bigger focus on?
Now, if you take an example, small errors in the data sets could be easily fixed when you're using these data sets for credit modeling. But if you have larger data sets, larger gaps in the data sets, they could be very material. And in such a case, you almost always have to go to the sources to obtain raw information, which could be very time consuming, and then need to tie up your resources. Now, in such a case, the only option left would be then to drop the entire records of information or drop the attributes or the columns from your data sets. And the data set then you produce may not be representative of the population, and hence any models that are built on these data sets may not lead to accurate decisions. Now, governance regulations such as BCBS 239 have brought about an awareness of what controls should be in place, what processes the bank should follow, and most of the people as working on these processes have now started to think about if we, for example, resource information from certain systems, then how do we address completeness and accuracy? And then when we transform this data or aggregate this data for, let's say, reporting purposes beyond credit risk decisioning and credit risk modeling, then how do we ensure that the data that is landing in your reports is accurate and complete? So there's this awareness around this, and most of the people now understand what needs to be done to ensure that the data remains complete and accurate throughout the reporting process.
Ivy, did you have anything you wanted to add to that?
I agree with Vikas. In terms of data governance, it's about creating awareness, and I think financial institutions are starting to realize it's not about just putting together a framework and asking people to follow the rules, but more of like creating awareness throughout the entire organization for people to be aware that whatever data that you key in or you use is actually critical. You need to be comfortable, you need to be able to trust it so that at the end of the day when the results come out, everybody can use it. So yeah, I totally agree with Vikas.
Indeed. And I think that probably changes the structure of teams and jobs. I think you have to institute checks and balances to make sure that, before you get to the automated stage, you want to make sure that you have a lot of checks and balances to make sure that data integrity is good. But what we're hearing from a lot of people about new technologies and with having to put the infrastructure in place to live up to these regulations, that some of the processes that were a little more manual before are being automated, and therefore people are beginning to work a little more strategically because some of the tedious elements of their jobs are now automated. Are you finding that as well, or are you finding that in working with the data, getting it ramped up to an automated stage is really consuming of resources?
So I can take that. So most of the clients that we work with here in Singapore and across ASEAN, a number of large banks have institutionalized, centralized data governance process that kind of ensures that the data you are feeding into any automated process is fit for purpose. Essentially, the processes ensure that the controls around accuracy and completeness are implemented and tested regularly for their operating effectiveness. And as this data feeds into the automated process, there's a certain level of standards that are being followed as part of that process and are being checked to ensure that the automated process doesn't fail. At the same time, when you automate any process, and particular reporting process, there could be controls or checks and balances or verification processes or reconciliation processes that could be built as part of automation that would provide a continuous check against the standards that the banks have set as part of automation.
With these processes in place and with automation, I mean, what do you think is most exciting about the new technology, and what do you think are the best opportunities that are being created by it?
So, I think if you look at how BCBS 239, for example, has provided this level of awareness around accuracy and completeness of the reporting processes, and whether this data set is used for credit risk modeling or any other purposes, the set of standards and principles are about the same. You could potentially apply the same principles to how the data sets are being produced for your models versus how these data sets are being consumed in your financial reporting or regulatory reporting or even internal risk reporting processes. So this provides an excellent opportunity to financial institutions then to establish a common set of principles and then translate them to a common set of standards that are applicable to a wider range of functions within the institution.
I think that's a really great point, and I think, Ivy, let me see if you, I mean, one of the things that when I talk to people about any kind of regulation or standard, is there really opportunities for people to do their jobs better and more completely and, with greater cognizance of the impact. Are you finding that, in implementing things like IFRS 9 and BCBS 29, that these are really helping your organization function optimally?
Okay, in a way, yes, because when there's regulatory changes or when there's guidelines that is given by some authority, a lot of time it forces the people doing the job to re-examine what they're doing. In a big organization like a bank, there are always a lot of processes, there's always a lot of procedures that sometimes it becomes routine and everyone just basically does it step by step, day in and day out. So with all this implementation of new rules or new regulations, like for instance IFRS 9, traditionally when we talk about accounting standards, we always think that the finance guys are the one, they'll be doing it and they'll be passing the entries and everybody else was like, totally clueless as long as the accounting entries gets passed. But with IFRS 9, what happens is it just forces the various departments, like the credit people, needs to get involved because they need to start talking about staging, provisioning, and then the finance guys suddenly realize that, hey, it's not just about passing accounting entries. They need to know about the criteria. They need to know about the definition. So it actually not just forces people to think differently. It actually equips people with additional knowledge and creates more awareness. So at the end of the day, everyone is wiser, so to speak, and they're able to do their job better. That's my view.
Do you have anything to add on that, Vikas?
Yeah, I think these regulations definitely, I think, as I mentioned before, financial institutions have to maintain a certain bench strength to run these processes. And as Ivy mentioned, that it impacts a broader set of functions within the firm. So if you train your people with the right skill set and expertise, it helps leveraging the same team to run the processes, whether it's for IFRS reporting or measurement or whether it's for CCAR measurement and reporting. There's a certain commonality across these standards, and I believe that the same skill set can be leveraged across them. So I think it also provides an opportunity to people to upskill themselves, learn these new governance standards, including new technologies and new methodologies for credit risk modeling and decision making. And I think this is an excellent opportunity today that these regulatory changes as well as technology changes present to the people in general.
And you've answered one of my questions, which is, essentially, how are people's jobs changing because of these implementations, and how do they affect, other systems of work, and I think that they do. It seems to me that when I talk to risk practitioners in this arena, that they are finding that the lessons they learn from implementing any new standard or regulation or having to ramp up for a new technology really give them a skill set that works across areas of focus. Am I hearing that from you as well? Clearly, am I understanding that correctly from you? And if so, do you think that there's anything we've learned from the implementation and planning of IFRS 9 or any of these other standards that has specifically helped teams that are not necessarily tasked immediately with implementing them?
I agree with your observation. In fact, you're right. For a lot of people, having to implement and learn new things arising from all these changes actually acquires them new knowledge and new skill set, which is transferable. So it's not just like, when you're doing the IFRS 9 implementation and you learn all about IFRS 9 and that's it. Once IFRS 9 is over, the knowledge is no longer relevant. It's the skill set that you learn in, for instance, cooperating with other departments, learning about new things. Like, for instance, you're a finance person and suddenly you get exposed to all the credit knowledge. All this comes in useful, and these are transferable skills that going forward, especially, which I believe that cross-functional team is the way to go. It will actually equip you with the skill set to function more efficiently. So for other teams that have not gone through this regulatory process, from the outside, when a person look at it, it may be a little bit overwhelmed at first to say that, there's so many new areas that I need to learn. There's so many new areas that I need to adapt. But it's actually good. It's actually a good adaptation because it opens up your knowledge. It actually allows you to acquire new skill set, and I would say that from my perspective, your job is changing for the better because you're learning more things, you're being more agile, you are in fact contributing in a different way, not just by processing certain things, but more of like contributing to a bigger goal than just getting the report right, for instance. That's how I look at it.
And I think that's what I'm hearing from people in other areas as well. Vikas, did you have something to add?
Yeah, sure. I'd like to add to that. I think it goes beyond also the team skills and expertise that you've built. Now, if you look at it from a bank point of view, and if I'm sitting in a bank and taking decisions about investing my budget across various projects, I would say that IFRS 9 and other transformational regulatory changes allowed me to upgrade IT infrastructure, set up data governance, and train my people to run the new process. So I would then like to make sure that the investment I have made in these processes would be useful for the other initiatives in the future. So, for example, the same sources that are being used for obtaining data for IFRS 9 could also be leveraged for CCAR or other reg reporting processes. The same teams that have worked on IFRS 9, they could then be used to build other credit models and run other credit models. And I think one of the important elements is that the firms themselves gain an immense knowledge and significant knowledge about their own data and risk profile that is quite valuable in the long term, and especially in improving the credit decision-making process or any other management process through which firms make decisions.
You both are very articulately stating this, and I really, truly appreciate it. Just a couple more things I wanted to ask before we wrap up. As you are based in Singapore, and we've heard a lot, our listeners have heard a lot, and I've had a lot of contact with people who are based in North America and EMEA, do you find that there are any challenges that you're dealing with in Singapore that come across regulatory or technology changes that are occurring in North America? Particularly a really good example of this would be CECL versus IFRS 9. When you're dealing with a multinational corporation, they may fall under various jurisdictions and have to comply with both. Are you guys finding any challenges along those lines, or are you finding that these processes are robust enough to be applicable to, whatever challenge comes down the pike?
Look, fundamentally, if you just take the example of CECL and IFRS 9, they are based on the same set of principles. Now, there are definitely differences in the way you measure expected credit losses. However, If you look at any regulations, the regulatory changes are generally, since they're based on the same principles, you could essentially leverage the same knowledge and infrastructure. And what we are seeing in some of our clients, the large financial institutions, they have started to build strong, centralized regulatory compliance functions that are able to manage and report on this change. I mean, certainly there are challenges because you have to, again, ensure that the people in these functions are adequately trained, you hire the right talent, you retain them. But however, this knowledge is essential to understanding the cross-border differences across the regulations. Now, having said that, I would like to mention one thing, though, that the technology has started to show quite a bit of promise in managing, in especially identifying this change, and then assigning these changes to the right parties who would then have to address the regulatory change, be it IFRS 9 or any other regulatory change for that matter. I'm not sure that I answered your question, Delisa.
No, you did, and I think that's a really good point about the technology, and I think that's part of the hope of it is that, that it will allow for efficiencies. Ivy, did you want to comment on that, on sort of, the different regulations that come from, different parts of a firm?
I mean, yes. For my banking clients, especially the big MNC banks, yes, they do have the challenge of having to manage all the different accounting standards and different regulations from different regions. Even let's talk about ASEAN itself. Is like there's all the local standard versus the international standards and so on and so forth. What I'm seeing is also, as per mentioned by Vikas, a lot of them, they use technology to try and streamline as much as possible their basic operations between the home country and the foreign operations. And in addition, what I've seen them doing is they actually use what term as the local subject matter experts who are familiar with the nuances of the local regulation, and they are the ones who actually will then drive and manage the differences in terms of the requirements. Most of the times is in the end user reporting, as they put it. So this is how I see a lot of the big multinational firms dealing with the differences in terms of all the regulation that's coming out at different regions.
Definitely. Thank you both for that. And I think that that's a really interesting point about, using your sort of on the ground expertise to connect, to the larger whole, as well as technology. Is there anything else? I want to give you both an opportunity. If there's anything you want to share with our listeners, we really appreciate any insight and certainly the perspectives that you've shared today. Is there anything else that you would like our audience to know from your vantage point that you think is important for them to understand about this arena? Let's start with Vikas.
I think so as I mentioned in a couple of answers earlier, I think technology is definitely showing a lot of promise in automating the processes, in also allowing us to build new credit risk models. I think one of the challenges remains that you need to then think about how this will impact the controls and the governance. For example, the regulators have started to put forward their views about the use of artificial intelligence and machine learning in credit decision or any and in particular decision-making process. So in such a case, how these principles will evolve, how these views will evolve would have certainly an impact on what decisions we make in the credit risk modeling world. And I think going forward, as this technology evolves, we will definitely find new opportunities to build and implement models in new ways. And then we will definitely find ways to address the explainability and less transparency that we have today in some of the new techniques and how those outcomes relate to the input data.
Thank you. Thank you very much, because Ivy, do you have anything you want to add?
Sure. For me, credit risk modeling is a tool, just like any other tool that helps to give one the advantage to do your job better. But end of the day, what is important is the data, because I think for everyone knows that what we have this saying to say garbage in and garbage out. So a lot of times is data that goes into any modeling tool. You have to understand, you have to trust it. So therefore, things like governance is critical. You need to be sure what you put into any system, be it using technology, be it using any modeling techniques that you can trust, so that the results then will be meaningful for you. And that is the message that I like to I like to give to the listeners, that when you're using any tool, please remember that the tool is only as good as what you have inputted into the system.
That's very well put. Thank you both. I thank you both very much for your time today. I hope that you have a great rest of your day.
Thank you very much for your time, and appreciate the opportunity of speaking on these topics.
Thank you, and have a good day. Actually, it's a good evening too.
Yes, indeed.
And thank you for joining us on the new age of risk analytics. Please subscribe on your favorite podcast platform to be notified of future episodes, and visit sas.com/risk for information on these and other risk topics.